I am Mrs. R. Kavitha, Assistant Professor and Head, Department of Business Administration, A.D.M College for Women, Autonomous, Nagapattinam. I am going to take the topic Capital Structure in the subject Financial Management. Okay, let us see what is Financial Management. Financial management is the operational activity of a business that is responsible for obtaining and effectively utilizing the funds necessary for efficient operations. Objectives of financial management. We have two important objectives, profit maximization and wealth maximization. Okay, let us see profit maximization. Profit earnings is the main aim of every economic activity. A business, being an economic institution, must earn profit to cover its cost and provide funds for growth. No business can survive without earning profit. The following arguments are advanced in favor of profit maximization as the objective of business. When profit earnings is the aim of business, then profit maximization should be the obvious objective. Profitability is a parameter for measuring efficiency and economic prosperity of a business enterprise. Thus, profit maximization is justified on the grounds of rationality. Economic and business conditions do not remain same at all the times. There may be adverse business conditions like recession, depression, severe competition, etc. A business will be able to survive under unfavorable situation only if it has some past earnings to rely upon. Therefore, a business should try to earn more and more when situation is favorable. Profits are the main source of finance for the growth of a business. So, a business should aim at maximization of profits for enabling its growth and development. Profitability is essential for fulfilling the social goals also. These are the limitations of profit maximization. First one is ambiguity. The term profit is vague and it cannot be precisely defined. It means different things for different people. Ignores time value of money. Profit maximization objective ignores the time value of money and does not consider the magnitude and timing of earnings. Then ignores risk factor. It does not take into consideration the risk, the prospective earnings of stream. Dividend policy. The effect of the dividend policy on the market price of shares are also not considered in the objective of profit maximization. Then wealth maximization. Wealth maximization is the appropriate objective of an enterprise. Financial theory asserts that wealth maximization is the single substitute for a shareholder's utility. It serves the interest of owners as well as other stockholders in the firm. It is consistent with the objective of owners' economic welfare. The objective of wealth maximization implies long-run survival and growth of the firm. The effect of dividend policy on market price of shares is also considered as the decisions are taken in to increase the market value of the shares. The goal of wealth maximization leads towards maximizing stockholders' utility and value maximization of shareholders. Then, scope of financial management. First one is estimating financial requirements. The first task of a financial manager is to estimate short-term and long-term financial requirements of his business. For this purpose, he will prepare a financial plan for present as well as for future. Then, deciding capital structure. The capital structure refers to the kind and proportion of different securities for raising funds. After deciding about the quantum of funds required, it should be decided which type of securities should be raised. It may be wise to fixed assets through long-term debts. A decision about various sources for funds should be linked to the cost of raising funds. Then, selecting a source of finance. After preparing a capital structure, an appropriate source of finance is selected. Various sources from which finance may be raised include share capital, debentures, financial institution, commercial banks and public deposits, etc. Then selecting a pattern of investment. The selection of an investment pattern is related to the use of funds. Then proper cash management. Cash management is also an important task of finance manager. He has to assess various cash needs at different times and then make arrangements for arranging cash for purchase of raw materials, make payments and creditors, meet wage bills, meet day-to-day expenses, etc. Then implementing financial controls. An efficient system of financial management necessitates the use of various control devices. Financial control devices generally used are return on investment, budgetary control, break-even analysis, cost control, ratio analysis, cost and internal audit. Then proper use of surpluses. The utilization of profits or surplus is also an important factor in financial management. A judicious use of surplus is essential for expansion and diversification of firms. Okay, let us see the theories of capital structure. First, we see the meaning of capital structure. The term capital structure refers to the relationship between the various long-term forms of financing such as equity share capital, preference share capital and debentures. Definition of capital structure. According to Christenberg, capital structure of a company refers to the composition or makeup of its capitalization, and it includes all long-term capital resources, vice, loans, reserves, shares and bonds. These are the forms or patterns of capital structure. First one is equity shares only, equity shares and preference shares, then equity shares and debentures, then equity shares, preference shares and debentures. Okay, these are the theories of capital structures. We have four important theories. First one is net income theory, net operating income theory, the traditional approach and Modigliani and Miller approach. First we see the net income approach. According to this approach, a firm can maximize the weighted average cost of capital and increase the value of the firm as well as market price of equity shares by using debt financing to the maximum possible extent. This approach is based upon the following assumptions. The cost of debt is less than the cost of equity. There are no corporate taxes. The risk perception of investors is not changed by the use of debt. Under the net income approach, we can calculate the value of the firm by this formula V is equal to S plus D, where V is equal to total market value of a firm. S means market value of equity shares and D is equal to market value of debentures. And overall cost of capital or weighted average cost of capital can be calculated as KO is equal to EBIT by V. EBIT means earnings before interest and tax. Then net operating income approach. It is diametrically opposite to the net income approach. According to this approach, change in the capital structure of a company does not affect the market value of the firm and the overall cost of capital remains constant irrespective of the method of financing. This approach is based upon the following assumptions. The market capitalizes the value of the firm as a whole. The business risk remains constant at every level of debt equity mix, and there are no corporate taxes. Under the net operating income approach, we can calculate the value of the firm by this formula V is equal to EBIT divided by KO, where V is equal to value of the firm. EBIT means net operating income or earnings before interest and tax. KO is equal to overall cost of capital. S is equal to V minus D, where S is the market value of equity shares. V means total market value of the firm. D is equal to market value of debentures. Traditional approach. The traditional approach is also known as intermediate approach and is a compromise between the two extremes of net income approach and net operating income approach. According to this theory, the value of the firm can be increased initially or cost of capital can be decreased by using more debt as a cheaper source of funds than equity. Thus, optimum capital structure can be reached by a proper debt equity mix. Then Modigliani and Miller approach. Modigliani and Miller hypothesis is identical with the net operating income approach if taxes are ignored. However, when corporate taxes are assumed to exist, the hypothesis is similar to the net income approach. These are the assumptions of approach, that is Modigliani and Miller theory. There are no corporate taxes. There is a perfect market. Investors act rationally. The expected earnings of all the firms have identical in risk characteristics. All earnings are distributed to the shareholders. The cut-off point of investment in a firm is capitalization rate.